Next comes the bonus shares. Bonus shares can be issued by the company from the profits of the company. If the company has profits and company is in the need of the money, is in the need of the capital, company can use its capital, but company can use its profits, but the process of capitalization of profits has to be followed by the company. So this profit is in the form of unissued shares of the company. So we convert them in the form of shares. We issue them to the existing shareholders of the company as bonus shares, so that the number of shares increases and the profit gets converted into capital, because shareholders are not required to pay any amount for the allotment of these shares. So the company, through the process of capitalization of profits, converts shares, converts the profit of the into the shares, and the share capital is raised. Now over here, this issue of bonus shares can be done by the company only when it is authorized by the articles of the company, and section 63 of the Companies Act 2013, it deals with the bonus shares of the company. It says that amount which is lying in the free reserves of the company, or in the securities premium account, or in the capital redemption reserve of the company, that can be used by the company for the issue of bonus shares. And one point over here is important, that the amount which is raised by the company through revaluation of the assets, that amount cannot be used by the company for the purposes of issuing bonus shares to the shareholders. The next is sweat equity shares. As the name indicates, that they are given for some work which is done by the employees of the company or the directors of the company. So sweat equity shares, they are given to the employees or directors of the company at some discount and or for some consideration other than the cash. So it can be that the employees, they have provided technical know-how to the company, or they have given certain technological assistance to the company. So company is paying them in the form of equity shares. So that is in brief about the sweat equity shares. Let's come to now what is a share. So if we define what is a share, we say that a share is a share in the share capital of the company, and it includes stock also, where the distinction between shares and stock is maintained. This is the definition. So when the capital of the company is divided into small units in the form of shares, which are taken up by the investors, and investors, they contribute from their share to the share capital of the company, we say that these are the shares in the hands of the investors or the shareholders, because they are contributing towards the capital of the company. Now what is the nature of a share? There are two types of properties, active properties and passive properties, that is chosen action or chosen possession. Chosen possession is a property which is in possession of the property owner. So share is a type of a property which is chose in action, because we do not have the possession. The possession is with the company, because company is using that money, whereas the certificate or the evidence is with the shareholder that he is holding so many shares. This is given, the evidence of this, that he is holding this property which is in possession of the company, is in the form of share certificate. So the nature of the shares is that they are a property which is chose in action rather than chose in possession. Now shares, they are bundles of rights, but along with that there are duties also, but they are bundles of rights, but they are a special type of properties, and it is said that they cannot be transferred from one hand to another like bales of cotton. So when they have to be transferred, the full procedure of the transfer has to be followed by the shareholders of the company. And section 44 of the Companies Act 2013, it provides for the nature of shares, and it says that shares, debentures or other interest of a shareholder or a member in a company will be freely transferable in the manner which is provided by the articles of the company. So this indicates that shares are freely transferable, and the manner of transfer is provided by the articles of the company. Over here we should understand that shares of a public company are freely transferable, whereas private company, according to its constitution, since it is private in the nature, it can have a restrictions in the free transferability of the shares, that directors will have to approve the transfer, only then shares can be transfer. So, this is in brief about the what is shares and what is the nature of the shares. Let us come to shareholders and members. Who are shareholders and who are members of the company? Both these terms are used interchangeably, but we need to understand the difference. Every shareholder is a member, but not necessarily every member is a shareholder of the company. That indicates that member is a generic term, a broad term, and shareholder is a type of a member. So, if the capital is divided into shares and shares are subscribed by the investors, they become the shareholders of the company, but they are also the members of the company. So, section 255 of the Companies Act 2013, it says that following category of persons can be members of the company. First, who are subscribers to the memorandum. Second, who have agreed in writing to become the members of the company and their name has been entered into the register of members. And third, any person who is holding shares and whose name is entered as a beneficial owner of the shares in the records of a depository. All of them they are members of the company. So, first category is those who are subscribers to the memorandum. We know that a public company needs minimum 7 persons to get incorporated. Now, these 7 persons, they have to subscribe their names to the memorandum, then the company can be incorporated. So, they are known as subscribers to the memorandum. So, by their subscribing to the memorandum, they became members of the company. The second category, where a person agrees to become a member of a company in writing and his name is entered into the register of members. Over here, a person who, let us say, he is not holding a shareholding of the company, but he gives a guarantee to the company that at the time of winding up of the company, he guarantees to pay this much of amount of money to the company at the time of winding up only, and he agrees to become a member in writing and his name is entered in the register of members, then he becomes a member of the company. The third is in the form of shareholders of the company. Now, where the shareholders, they are having shares in the physical form, that is not in the dematerialized form, they are in the materialized form, then the company is maintaining its register and name of the shareholders is entered. Shareholders are entered into the register of members. Whereas, in the case of dematerialized shares, where the dematerialization is through the means of a depository, the register of members is maintained by the company in which the name of the depository is written, and the depository itself maintains a register where the shareholders' names are maintained as the beneficial owners of the shares. So, any shareholder whose name is written in the depository's register as a beneficial owner of the shares which the depository is holding in the company, then they will also become they will also be known as the members of the company, being shareholders of the company in the capacity of being beneficial owners of the shares. Now, so let us look at in how many ways a person can become a member of a company. So, first will be by subscribing to the memorandum, second by allotment of shares, third by agreeing in writing to become a member of the company and the name is entered in the register of members, fourth will be beneficial ownership of members in case of dematerialized shares. Then fifth will be transfer of shares, because when one member is transferring, one shareholder is transferring his shares to another, the transferee will become the owner of the shares. So, then he will also become the member of the shares. And a last process will be transmission of shares, where a shareholder dies and his legal heir or his representative becomes entitled to those shares by operation of law, and the company is notified of this, that there has been, the shareholder has died and his legal heir or representative has becomes the shareholder of the company by operation of law. So, these are the methods in which a person can become a member of the company.